How does extrinsic value affect selling options? Have you ever wondered how the concept of extrinsic value plays a role in selling options? Understanding this can really change the way you approach options trading. Extrinsic value is the part of an option's price that goes beyond its intrinsic value. It reflects the potential for the option to become profitable before it expires. When you sell options, this extrinsic value is key in determining the premium you receive and the overall risk and reward of your trade. So, what influences extrinsic value? The two main factors are the time left until the option expires and the implied volatility of the underlying asset. When there is more time until expiration, the extrinsic value tends to be higher. This is because there is a greater chance for the stock price to move in a favorable direction. Similarly, if the implied volatility is high, the extrinsic value increases. This is due to the market anticipating larger price swings that could make the option profitable. For someone selling options, extrinsic value represents the premium collected upfront. A key point to remember is that extrinsic value decreases over time, a phenomenon known as time decay or theta decay. As time passes and the expiration date approaches, the extrinsic value declines more rapidly. This can be beneficial for the seller, as they may buy back the option at a lower price or let it expire worthless, assuming the stock price does not move against them. However, it is important to note that higher extrinsic value also indicates a greater risk for the seller. If the market believes there is a higher chance for the option to be profitable, this translates to increased risk. Factors like interest rates and expected dividends can also affect extrinsic value, but they play a smaller role. In practical terms, many sellers prefer options with higher extrinsic value because they can collect larger premiums. However, they must weigh this against the increased risk of adverse price movements. Selling options with high extrinsic value is common in strategies such as covered calls or cash-secured puts. In these strategies, the seller aims to profit from the natural decay of extrinsic value while managing their risk. In essence, extrinsic value significantly impacts selling options by determining the premium received and the potential profitability of the trade. Sellers can benefit from the decay of extrinsic value over time, but they also face higher risks when that value is elevated due to longer time frames or increased volatility. Understanding these dynamics can help sellers make informed decisions about which options to sell and when to do so.